Welcome, ladies and gentlemen, to Real Estate Roundup. Today we're going to be joined by Jennifer Burnett of Pennsylvania Preferred Mortgage Company. We're going to get right to the Who Knew section. So in 2000, the dot-com bubble burst, wiped out roughly $6.2 trillion in household wealth and led to a mild recession. Conversely, in 2007, the housing bubble burst, wiped out roughly $6 trillion in household wealth, but led to a great recession. So the question is, why such different outcomes despite seeing similar nominal dollar losses? The answer when we come back. Welcome back. Before the break, we posed the question as to how did two significant downturns in the economy have such different impacts on the economy. And basically, what it boils down to, there are many reasons for this, obviously. It's not a simple equation, but the underlying foundation of why there was such a stark difference in the two bubbles bursting was the distribution of losses and retail spending. These were the two key roles. The tech crash in 2000 concentrated losses on the rich, but the rich had very little debt and didn't have to cut back their spending, whereas the housing crash in 2007 concentrated losses on people who could least afford it, and it disproportionately affected poor homeowners who then had to stop spending. Look at it another way. If Warren Buffett lost $100,000 on a bad investment, it's not really going to impact him that much as far as his retail spending is concerned. However, if you have a household that has $125,000 in net wealth and they lose $100,000, that's going to impact them significantly, and they're going to have to cut back their spending. So that's why the housing bubble of 2007 darn near tanked the economy and led to the Great Recession, whereas the tech crash in 2000 really was a minor blip, even though both of them, for the most part, wiped out the same amount of household wealth, a little over $6 billion. So, who knew? Okay, joining me now, as promised earlier, is Jennifer Burnett. She is with Pennsylvania Preferred Mortgage. Jennifer, welcome to the program.
Thank you for having me.
My pleasure, my pleasure. And let's start big and whittle it down to details.
Sure.
Back in December, as obviously you're well aware more than I am, the Feds, after almost a decade.
Yeah, 7 years.
Yeah, they just nudged the interest rate up a little bit.
Mm-hmm.
From the consumer level, have you really seen any difference in lending markets, credit markets? Has that really impacted the consumer as far as getting a mortgage?
Sure. So, there is a correlation there. There is a relationship with the Federal Reserve raising, a quarter of a point, percentage point. However, what people sometimes don't realize is mortgage rates are tied to the bond market more so than the Federal Reserve.
Okay.
So, quite honestly, the rates have, stayed on par, maybe even dipped down a little bit by 1/8% or gone up by 1/8%, but we haven't really seen the effect on the mortgage interest rates at this point. They're still very low. I'm anywhere, depending on qualifications, loan to value, mortgage type, residential loan type, anywhere from 3.5% up to 4.125%.
Okay.
So they're still very low, all-time historical low.
Now, is that for a conventional 30-year mortgage?
We're
rates?
talking, that range would be, your FHA 30-year, your
Okay.
conventional 30-year,
Okay. So FHA, VA, conventional, the rate range is pretty similar?
Yes.
Okay. As far as access to credit,
Sure.
what are you seeing? Because I read reports, as I'm sure you do. One report says the credit is tightened. One says that it's loosened. You don't know who to believe anymore. So,
Right.
I mean, you're on the front lines. You see this every single day. Realistically, what are you actually seeing as far as availability of credit?
Sure. Very great question. So, probably the reason that you're getting mixed messages in the marketplace is what I'm seeing. Yes, it's painful to obtain a mortgage right now. The underwriters really want to make sure they have their I's dotted, their T's crossed, because what we have been through, that everything is documented. Money that you're using to purchase a home, that it's sourced, that there's a paper trail.
Unlike back in 2007,
Yes.
2008, if you could breathe and sign your name, you got money.
Right, and had a good FICO score, yes.
Right, okay, okay.
So with regard to that, it is, a little more tedious, I'll say. You really have to have everything documented. One change that I feel is impacting a lot of first-time home buyers, unfortunately, that I'm seeing, and it's a recent change, is with regard to student loan debt.
Okay.
It used to be if we could prove that the student loans were in deferment for 12 months or greater from the time the borrower closed on their home, we could omit that debt from their debt-to-income ratio calculation. Unfortunately, we can no longer do that on most of the loan products out there.
Okay.
It has to do with the ability to repay, ATR. We have to now count that debt, even if it's currently in deferment. We have to calculate, figure out what the projected payments are going to be on those student loans, and we have to factor that into the debt-to-income ratio calculation.
And what a lot of people don't realize, I think, is that when you get a loan, really the underlying factor, there are obviously, as you mentioned, just a few. There are several things that are involved. But the underlying factor that they look at is your ability to pay the money back.
Yes,
correct?
That is the single most important thing.
and that's unfortunate, because I understand that student loan debt is now over $1 trillion. And I think I read somewhere, if I'm correct, that it's now second only to mortgages.
Yes.
Which is scary.
Very.
That is very scary.
Yes.
So
I see it.
If they're if they're tightening up on that even more so, then that's going to put a damper on lending.
Yes, it is, especially for the first-time home buyers, like I said. But on that same note, I will say there's a general feel in the industry that lenders out there are looking to come up with programs, outside of the box type programs, to help people obtain financing. So yes, while things are becoming more tedious, more documented, they're looking at the ability to repay through a more scrutinized lens. I do see an effort out there to come up with other types of loan products that are outside of the box, that are reaching out to a wider range of people to qualify. I do see that effort out there.
Well, that's good. Now, is the inability is not the right word. The fact that the student loan debt is now not being forgiven, is that true with FHA and VA as well as conventional, or is this pretty much just conventional?
Okay, so this is a great question. It's on
I
conventional.
do that, I come up with great questions.
You do. I love it. It makes it easy for me.
It's my job.
So yes, on conventional and FHA. Okay. I will say on the VA loan, for the veterans out there, the military, can, as long as we can prove that it is in deferment for 12 or more months, you can omit those debts on the VA product.
Okay, so the
It's the
VA
only
gets
product.
a little bit of a break
Yes.
on that.
Yes.
Again, as long as it can be documented.
Yes.
Okay. Okay. The types of residential mortgages, you like we talked about a little bit. You hear about conventional, FHA, VA, jumbo. That's another term that's thrown out there a lot. What, just very briefly, what is available to a homeowner as far as mortgages,
Sure.
and what are the basic differences without getting into too much bogged down detail?
Sure. Well, the FHA product, government-backed product, you could do a 30-year or 15-year fixed rate. Tends to be a slightly lower interest rate than conventional.
Okay. Now,
Biggest.
excuse me, when you say conventional, we're talking about typically a bank or some type of lending institution like Pennsylvania Preferred Mortgage, correct?
Yes.
Okay, all right.
Just a conventional, traditional 30, 15-year fixed rate mortgage.
Okay.
With FHA, it appeals to people who have little to no money down, where they could do the 3.5% down payment. And then you can ask for up to 6% seller assist.
Explain that a little bit, how that
Sure.
works.
That's where you're asking the seller to give you 6% of the agreed upon sale price towards your closing costs. That can only go towards your closing costs and prepaids. It cannot assist you with down payment.
So in essence, what you're doing as the buyer is you're financing your closing costs.
In a way, yes,
Okay.
because oftentimes the seller, has in mind what their net profit needs to be on the sale of their home, and you might have to go, a little higher, come in with a full price offer to get that from the seller. So that's very helpful. The one caveat that a lot of people need to be aware of with the FHA mortgage is when you are doing the minimum down payment, the mortgage insurance is on there the life of the loan.
That's with FHA.
Correct.
Got it. Okay.
It never comes off.
Okay.
So then you flip over to the conventional 30-year fixed, slightly higher interest rate. We do at Pennsylvania Preferred Mortgage have the option for 3% down, which is very nice. A lot of lenders out there are 5% down. We will go to 3% down on this product.
Okay.
With regard to the seller assist I just mentioned on FHA, you're capped at 3% seller assist on conventional when you are doing the minimum down.
Okay. All right.
But the nice thing is, if you plan to retain the property for 10 or more years, when you reach that 78% loan to value, that mortgage insurance is going to terminate. It's going to come off.
Okay.
So conceivably the payment could go down.
Okay. So if you're looking at the life of the loan between conventional and FHA and you incorporate the cost of the mortgage insurance, it's possible that a conventional loan would be your best bet as opposed to an FHA loan.
It's really important when the buyers are out there looking for financing that you are working with a loan officer that's really going to take the time to ask the questions. Are you going to be in the property long term? If you're not, it might be best to go FHA. Or what's your hurdle? Is it, you got to keep the monthly payment as low as possible, or you have to bring the least amount of cash to close? When you ask these questions, you can guide them.
Okay, good deal. FICO score.
Yes.
Every time you turn on the TV, FICO score this, FICO score that. Let's start with the very basics. What is a FICO score? Because I'm sure some people don't know. Until I got into the business, I didn't know what the heck a FICO score was.
Yes.
So what is it and why is it important?
Okay, so FICO originated from Fair Isaac Corporation. It was a corporation that came up with these complicated logarithms and measures to really determine what your FICO score was, what your credit worthiness was,
Okay.
how good or strong of a potential, client to obtain credit, how strong you are. So,
and again, I'm assuming that these algorithms that they use, a big chunk of that is your ability to pay the money back.
right. So there's a
Okay.
few key factors they look at.
Okay.
They look at the longevity. How long have you had credit? Okay. The longer you've had credit in good standing, the better.
All right.
What type of credit you have? Do you just have a ton of revolving credit cards, or do you have an auto loan? Do you have a student loan? Do you have a mortgage? So they do look at the type of credit.
Okay.
They also weigh heavily on the balance. Okay, so if you have a revolving credit card with, say, a $10,000 limit, they want to see you paying that off every month. Or if you can't do that, maybe, a lower, around 20-25% balance. They don't
Okay.
like to see high balances. That harms your score.
Okay.
Even if you're making on-time payments.
Okay.
They really don't like to see the high balances.
All right.
So keep low balances. Obviously, make on-time payments.
Sure.
That's
a
obvious.
big one. Yeah.
And then they also look at credit inquiries. So a question I always get.
Go ahead, because I was going to ask you about that, and you're probably going to bring it up. So go ahead.
Yeah, so clients always say, I'm looking to buy a house, I'm not sure what time frame, or I know I'm 6 months out, or I was just pre-approved with someone else, but I wanted your opinion. But they're always concerned about their credit, as they should be. Credit inquiries, it depends on how strong your credit is to begin with. I mean, certainly you don't want to have your credit pulled regularly. They like to see the lowest amount of credit inquiries as possible. What I tell people, a good rule of thumb is, they kind of understand shopping for a mortgage. You have a
Right.
mortgage company pulling your credit. You want to limit that to maybe 2 to 3 times.
Okay.
What you really don't want to do is decide to buy a home, maybe buy an automobile,
Right. All
and
one
apply
time.
for a credit card all at one time.
Now, let me ask you about that, because I find this fascinating, and hopefully you can explain it, because I've asked this question to others, and I really have not gotten a satisfactory answer.
Okay.
You see commercials. Check your credit, check your credit,
Yes.
check your credit, check your credit. Now, you just said if you check your credit too much, check your FICO score too much, it actually works against you.
Right.
So my question is, obviously these companies that keep espousing, continually check your FICO score. There's something in it for them. What is in it for them? I can't understand what their motivation is for someone to keep checking their FICO score.
Well, I don't necessarily know what's in it for them. I will tell you that's more of a soft inquiry, so it doesn't impact the score too much when they're educating the consumer on where their credit score is at.
Okay.
It is nice in the sense that they do alert the consumer every time their credit is pulled. Most of them do that so that, hopefully the consumer is aware. If they're not, now they're alerted to it and they can research that. The only thing I can surmise, and this is just my personal opinion, I don't know for certainty, is that, they hope to gain a database of people who are
Okay.
qualified, and then they can turn around and sell those leads to,
So like everything else, it's marketing.
yeah.
Yeah. Okay.
That's what
That
I
makes sense.
believe.
Yeah, and that makes perfect sense. That makes perfect sense.
And something I do want to mention here, because I do get that a lot. People nowadays are taking their credit very seriously. They are getting onto these various sites, or through their credit card, they'll get reports on where their score is at.
Right.
And it is a good thing. But people tell me all the time, oh, I know my credit score, it's 743 or what have you. What oftentimes people don't realize is there's 3 credit bureaus out there.
Right.
Okay, so whenever you're applying for a mortgage, we pull 3 credit scores.
Okay.
The rule of thumb is you dismiss the high one, the low one, and you utilize the middle score for qualification purposes. So I cannot tell you how many times that credit score that they're informed of is not exactly the score we are using.
All right.
It's in the range, most certainly, but it's never the score we're using for qualification purposes.
Now, you had mentioned a couple things already about how to keep your FICO score good. Can you expound on that a little bit? If someone has a poor FICO score and they need to beef up their credit, they want to buy a home, and they may be 6 months to a year out, and they want to beef up their credit. What are some things that they can do to help bump that up?
Sure. So by no means am I a credit expert, but the biggest thing I look to when trying to advise someone, when I'm trying to help them get them to that stage of being able to buy, I look at their balances. That's the easiest thing to address, and it's going to help your score the most quickly.
Pay down your debt.
Pay down your debt. If they have a revolving card especially, it's not necessarily on an auto or student loan. That's an installment type debt. It's on the revolving debt. If I see they have a card that's a balance of, or a limit of $500 and they're at, $450, I'm going to say, when you get some extra money, please pay that down. That's really going to help your score. And it does.
Okay. Now, I have an aunt, and I'm sure I'm not alone. This probably happens a lot. If she has one credit card, she has a dozen. Honestly, she must have a dozen credit cards.
Okay.
However, she only uses 2 of them.
Right.
The other 9 or 10 are sitting in a box, and I ask her, "Why do you have these?" She goes, "Dear, in case of an emergency, if something happens and I get stuck, I have instant money I can go to." Now, is that detrimental to somebody's credit score? You have all these cards. The vast majority have 0 balances. In fact, you may have not even activated the stupid thing, but you still have on the list. You have 10
a lot of credit cards.
Yeah, is that a detriment to somebody's credit score?
I have been told in the past that if you have a line of credit that you are not utilizing, it is best to close it.
Okay.
I don't know that it's detrimental if it's not being used. It's just out there.
Now I know some companies, if the account is inactive for so long, they'll just automatically close it. But I didn't know if she's actually doing herself more harm, or I didn't know how that worked.
I'm not sure. The only thing I've ever heard is if you have open debt and you're not using it, it's best to just close it down.
Okay.
That does help the score a little bit.
Okay, good deal. Jumbo loans.
Yes.
I like the name. but
so do I.
What exactly is it, and how does it differ from a conventional loan, FHA loan?
Sure. So a jumbo loan in this particular area is any loan amount that exceeds $417,000. Okay. It's considered a riskier loan to the investor. It's a larger price point. So the guidelines are just different. And the interest rates tend to be a little higher.
Okay.
A little higher.
Just because the risk is a little higher?
Yes.
Okay.
That there's usually a direct correlation there. So I will say PA Preferred Mortgage, we have great jumbo rates right now. The biggest thing the consumer needs to look out for when obtaining a jumbo loan, there's a few things. First, we're going to talk about delegated versus non-delegated. Okay. Delegated is, the lender you're working with can underwrite the loan. All right. Okay. You always want to strive for that as a consumer because it allows the process to move a lot smoother. Less people working on it, direct communication. You know exactly what you need to provide because they're requesting it and they're dealing directly with you.
Okay.
There are a lot of brokers, correspondent lenders out there who, aren't delegated to underwrite jumbo loans, so it's non-delegated. What's happening in that scenario is they are underwriting the file, you think you're good, and then they send it to the actual investor who's going to purchase that loan, and then they underwrite it.
Okay.
So in the 12th hour of the transaction, something could come up.
Okay.
And it creates a headache. It creates an not so pleasant experience.
Now, in the case of going with undesignated, is that the correct term?
Non-delegated.
Non-delegated, I'm sorry.
That's okay.
In the case of going with a non-delegated jumbo loan, because you have more people touching the same piece of paper, are there additional costs involved with that as opposed to a
Not
delegated
typically.
or not really?
Not typically.
Okay.
No.
Okay.
We're so regulated on costs and what you can charge. You're not going to see a huge variance there. It's just extra steps in the process. It could be cumbersome.
Okay.
The other thing is, a lot of financial institutions out there will advertise really, really low rates, conventional rates on a jumbo, and you're thinking, how are they doing that? Be cautious because it's a two-loan process. They are giving you a true conventional non-jumbo product on the first mortgage.
Okay.
And then they're doing a second behind it.
All right.
Okay, so you really have to have an understanding of what type of financing you're getting. Sometimes they just tell you the overall payment. You think that sounds good as a consumer, and you go with it, but it's not really what you're looking for.
Okay.
We have both options available. Again, this is where myself as a loan officer, I really drill down, ask the questions, try to get an understanding of what their end goal is, and then I can advise based off that. The other thing you want to look out for on these jumbo products is something called reserves.
Okay.
Okay, so yes, you're going to have your down payment. You're going to have your closing costs. But because it's a riskier product, a lot of lenders out there want to see reserves, cash reserves. So whatever that mortgage payment is going to be on that jumbo loan on a monthly basis, they could want to see 6 to 24 times that amount in your bank account to be able to close.
Okay.
In addition to any down payment and closing costs.
Okay. Now the reserves are just within your existing account. They're not put in escrow, correct?
Right. Yeah,
Okay.
you retain that money, you
Okay.
keep it in your account, but you have to prove that you have that amount of money.
So proof
and
of
it
funds.
could be, yes. And it could be substantial. I mean, we're already talking jumbo, a higher price point, higher
Right.
loan amount, therefore higher mortgage payment.
Right.
Times, like I said, 6 to 24 months.
That's a lot. That could be a lot. That could definitely be a
So
lot.
that's something, I always, pay attention to.
Now, jumbo loans, Jennifer, are they strictly within the conventional market? For example, is there such a thing as an FHA jumbo loan?
No.
Okay.
It's a completely different product.
Okay. Okay. All right. Got it.
Yeah, actually, in this surrounding area, you bring me to a good point. On an FHA loan, the maximum amount you can finance is $271,050.
Okay.
So whenever I have someone that's not necessarily a jumbo,
Right.
but they're in the $300,000 to low $400,000 range, automatically they cannot go FHA unless they're going to cover that difference with a down payment.
Got it. Okay. Well, I'll tell you, this has been fascinating stuff. Is there anything that we didn't cover that you think may be important to the viewers, or anything that you'd like to bring up that we haven't spoken about?
Sure. Just, my recommendation out there, we are in a time where it is very document intense to obtain a mortgage. So if you're thinking about purchasing a home, selling your current home, buying a new home, it never hurts to reach out to a loan originator, mortgage consultant, to just talk and kind of understand what they're going to be looking for. Oftentimes people are moving money around, they're getting a gift. Well, now we have to create a paper trail, and that needs to be handled in a special way.
Okay.
Or they're going to withdraw from a 401k or take a loan out. All these things need to be handled in a special way. So it never hurts to have that conversation, open up that dialogue to make sure anything you're doing to prepare, you're doing it correctly.
Fantastic. Thank you for coming. I appreciate it.
Thank you for having me.
Ladies and gentlemen, that's a wrap. Thanks for watching.